Hey everyone. So, with the recent news of Google's actual win in its antitrust lawsuit, I figured it'd be a pretty good time to actually go over what I think of for the price of Google and where do I see it being in the next 5 years and how much I would be willing to pay for it right now. So, Alphabet currently is trading at a price of about 226 after hours, right? I know up here the chart, the number I have is only 211. That is because this is at the end of the day. So we just got the recent lawsuit that was essentially saying that Google and Alphabet itself does not have to sell Chrome. I'll probably be using Google and Alphabet interchangeably because on day to day, I mean, I call it Google, but we all know the company itself is called Alphabet. So I really did about three different methods to evaluate what I thought of the Google of Alphabet's real uh, intrinsic value. I looked at the sales, its type of growth, and its margins, looked at the free cash flow, and then I looked at its dividends. Obviously, the dividends portion isn't doesn't make as much sense simply because Alphabet doesn't pay as much of a dividend, right? If you're buying Alphabet, you're not buying it for the dividend yield, you're more so buying it because of all the other aspects that it has to it. So first off, right, let's take a look at the revenue and the margins. What we have is in the trailing 12 months, we see that Alphabet has had a revenue of about $30.23 per share. Its growth has consistently, if we take a look in here, none of this is really that pretty, but I was doing some analysis, right? Its revenue has been growing at about 18% as a median for the last 10 years, or 20% in the last 5 years if you take the CAGR, which is really fast revenue growth. And really, the only thing that we could really talk about against Alphabet were people saying that search is going to die. And that was really the only aspect of Alphabet or Google search that was could possibly really make an impact. But because of AI. But what we've seen is that recently, even with the AI influence, right, there hasn't been a decline really in the revenue. It's really stayed steady, and if anything, it's maybe declined, not even declined that look, but it really hasn't declined. It's really only gone up. So I'm pretty confident in saying that Alphabet would be able to sustain at least this 17, 18% revenue for the next 5 years. Of course, the other part that we do want to take a look at is the margins. Currently, the margin that Alphabet has, right, it's at around 31%, which is above its 10-year average and 10-year median of about 21 to 22%. And yet, I still think that Alphabet is going to get an even higher margin on the product. Why do I think that? Well, it's because it already has a few high margin areas. It has high margins when it comes to YouTube, when it comes to search, and now it's in this product, right? Google Cloud. Is its highest margin product, and that is also what is growing the fastest, meaning that all of it is going to actually add up to a much faster growing margin, and we could end up seeing Alphabet getting a much higher margin than what we see right now. I think a small increase in margin is probably reasonable. Of course, the margin is probably going to get cut into with some depreciation with their new recent assets, CapEx, that haven't been fully accounted for. But that's why we also have the free cash flow to take a look at. If you want to take a look at the calculations I did here, I'll link this Google sheet in the comments. So people who want to actually read it, you can come over and take a look at all my analysis and tell me where I'm wrong. Because obviously people are going to tell me I'm wrong. With all that put together, I do see that it's telling us that assuming that you are requiring a 15% growth rate, the intrinsic value for Alphabet is actually at about $250, which is still higher than 226, um, and even after the bump that Alphabet got from the recent lawsuit news. So next up, I do want to talk about the free cash flow, right? The free cash flow it looks a bit less rosy. It's still a really rosy picture, don't get me wrong, but it looks a little bit less rosy. Simply because if we take a look at the analysis here, the most recent couple of years, the free cash flow has not been great, right? Free cash flow has been taking a hit. It's really only been growing at like 13% as a median for the last 10 years, 20% CAGR for the last 5 years. But we also do want to take into account that the last few years had Alphabet has spent a lot on CapEx for NVIDIA chips for data center for growing the data centers. So all that put together necessarily means that they're going to have a lower cash flow for these last few years. So I'm not going to take it as a hit against them. I do expect that with their capex being probably trimmed down in the future, that their free cash flow is going to get up back up to where they were, what their actual 5-year growth rate is, around 20%. Assuming that 20% free cash flow growth, we also see that historically they really have had a price of free cash flow here, whether it is the median or the harmonic mean, right? Really about 29, 30-ish price to free cash flow. Putting that in with the free cash flow they have, subtracting out the debt per share that Alphabet currently has, which is minuscule compared to how much money they actually bring in. We get it to a price of about $230.23. So that's still a very reasonable price, especially for it's still lower. Sorry, the buy price here or the target price here would still be higher than what we have as the buying price, as the current price for Alphabet. On dividends, this one I'm just gonna gloss over it really because no one cares about the dividends as much. Of course, there's some people who care, but we have a trailing dividend of 84 cents. The growth rate, I'm going to assume a 20% growth rate for basically essentially just the track record. We have 1 year sample, not really anything that great. So let's say 20% and ending dividend yield of 0.5%, which is about what they have right now. Right? That'll get us a target price of about 212, which is lower. However, this is not really something I'm going to take into account, simply due to the fact that I don't really see Alphabet as something that should be priced on its dividends, and rather it should be priced on its growth potential, which would be its sales and free cash flow. That being said, right, what is the final price that I really think Alphabet should be priced at? Uh, for me personally, because am looking at for that 15% return per year, at least for the next 5 years, right? I the target price for me is probably somewhere between this 230 and 250 range. So I'm going to say the target price right now is probably 240. But for me, I am also very uh, conservative. I don't want to buy something which is just at fair value. I want to buy it below fair value. So personally, I want a margin of 50%, which to be fair, is kind of ridiculous. But if you did want just like say a 15% margin, then according to the sales and margin analysis, it is a good buy. And if you only require say a 10% return with a 15% margin, I believe even if we get up to like 30% margin, we're still saying that you're almost guaranteed. I'm not going to say guaranteed because that's false, but 10% for a 10% return, you have 30% margin baked into the actual current price. So do I think Alphabet would be a buy right now? I do think for a lot of people, Alphabet is a strong consideration to be take a look at. However, the chance to buy it really has pretty much passed, right? It was in such a dip before when all the stories about it were so negative that that it was trading for a much lower price than it is now. It is definitely not something that I would currently be looking into putting money into, but it is a position that I have and I will continue to hold it as it does show that Alphabet has a real potential to grow a lot more than this 15% that I'm requiring per year. And there is real potential uh, in additional value add. So let me know what you guys think of my analysis. If there's something wrong up to it, probably there is. Just let me know what I'm doing wrong. Uh, let me know what other companies you would like me to take a deep dive in. And yeah, thank you guys so much for watching.